Right now, India is currently the fastest growing major economy on the planet. This dashboard shows the scale of that growth, a $700 billion foreign exchange reserve, and a banking sector that has spent the last decade significantly strengthening its foundations. Historical patterns suggest that under these conditions, global investors would be competing for any available entry point into the market. By traditional economic metrics, India is positioned as a secure, high-prospect destination for large-scale capital. In spite of those fundamentals, foreign portfolio capital is exiting the country at a rapid pace. This chart tracks foreign portfolio investors, or FPIs. In fiscal year 2026, these funds recorded net outflows of $16.5 billion, a sharp reversal from previous years of steady accumulation. The trend intensified through the first half of 2026. Between January and June alone, foreign investors sold more than 2.8 lakh crore rupees in Indian equities. A withdrawal of this scale typically triggers a significant market crash, yet the Indian market remained steady. It raises the question of where that money is going and what is providing the support to keep the market from falling. Global capital is being rerouted toward artificial intelligence and advanced manufacturing as the primary search for growth shifts toward future technologies. Investors are concentrating their resources in the AI hubs of the United States and the semiconductor manufacturing centers of South Korea and Taiwan. These specialized hubs, like this TSMC facility in Taiwan, represent the physical infrastructure required for the current hardware revolution. India's technology sector has historically focused on software services and digital platforms, represented by giants like Infosys. While successful, this sector does not yet offer the same early lead in frontier hardware and chip manufacturing. This gap in hardware dominance is reflected in R&D spending. While Taiwan and South Korea invest heavily in research, India's national spending on research and development stands at 0.7% of its GDP. Capital is currently prioritizing countries that can demonstrate an immediate technological edge, causing India to lose out on this specific wave of innovation-driven investment. Even as foreign investors sell, the Indian market has displayed an unexpected level of maturity, held steady by a source of capital closer to home. Domestic institutional investors, supported by millions of regular citizens contributing through systematic investment plans, have stepped in to provide a continuous flow of capital. This chart compares the two forces. While foreign investors withdrew 2.8 lakh crore rupees in the first half of 2026, domestic institutions invested over 4.5 lakh crore in the same period. This internal pool of savings created a floor for the market, absorbing the foreign sell-off and preventing the type of volatility seen in previous decades. The Indian market is no longer as dependent on foreign sentiment as it once was. It is now increasingly driven by the confidence of its own domestic investors. Long-term confidence remains high, as evidenced by a record $94.5 billion in gross foreign direct investment. This shows that while short-term portfolios are moving, the commitment to building businesses in India remains intact. India has successfully managed a major financial stress test, demonstrating that its internal financial systems can withstand significant global capital shifts. However, a large consumer market and high GDP growth are becoming baseline expectations for global investors, rather than unique advantages. The challenge for the next decade is for India to evolve from a high-growth service economy into a center for frontier hardware and R&D. To maintain its position in the next cycle of global capital, India will need to bridge the gap between economic stability and technological innovation.